for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
Thank you for joining the Virtual Emerging Manager Forum, CTA Expo, and for clicking to learn more about what's going on in China, why you should be trading there, and stories from managers who are already successfully navigating the waters. RCM has held a global vision for years, positioning ourselves to capitalize on the large opportunity in China revolving around Chinese futures markets and the opportunity for U.S. CTAs to trade in the Chinese market through our manager due diligence, physical travel, when that was allowed, to create connections with strategies and PMs alike, and a continued push through Chinese-focused content to educate our clients. With that said, this isn't a soapbox opportunity for us to brag about our accomplishments, but more of an opportunity for us to give you some insider knowledge on the Chinese investment space and why you should be trading there. And there's no one better for that than our in-house director and China consultant, Matt Bradford. Matt, take it away.
I'd like to answer two questions today. Why look at investing and/or trading in China? And why work with RCM if you reach that decision to invest or trade in China? Let me first start by outlining who is RCM if you already do not know. RCM is a large, independent, introducing broker founded approximately 10 years ago. Our headcount is 60-ish, mostly here in our corporate office in Chicago, although we do have some small satellite branch offices domestically. And then we also have a global footprint working with a consultant in Geneva. We have an office in Madrid, Spain, and then also in China. So RCM, in terms of our size, we're executing, clearing, giving advice, consulting, and working with clients in the billions. RCM faces off with two types of clients. We work with traders and investors. By investors, could be an ultra high net worth, a family office, a farmer, small institution, or even a financial advisor and their clients. What do I mean by trader? A CTA, a CPO, a mutual fund, proprietary traders, or even larger self-directed retail traders. So what type of services are these investors and traders looking for? What does RCM offer? Multiple execution relationships, multiple clearing relationships, a 24-hour professional trading desk. We do have a fund outsourcing platform, marketing and cap intro, a suite of execution algos, and of course, China. So what is the opportunity in China? China currently is the second largest economy on this planet behind the United States and boasts one of the largest stock market and fixed income markets and an ever-expanding commodity market. With this growth trajectory, and as these markets get more westernized, a great opportunity presents itself for traders and investors alike. Let me share with you today some interesting statistics. Shenzhen, a fishing village just over 4 decades ago, is among one of the fastest growing cities in the world. There are over 10 cities in China with a population over 10 million. To put that into perspective, the approximate population in New York City is 8.5 million. Beijing is massive, massive. On a recent trip to China, I was I was in a Didi riding between meetings. And I, with my colleagues, traveled between Ring 5 and Ring 2. We were in the car for over 2.5 hours and did not even make our way all the way across downtown Beijing. Every time I go there, and I've been there 4 times over the last 3 years, we're doing 50 plus institutional meetings. So there is a big interest from China investors and China traders. And we think this is just the beginning. Just recently, China built a hospital in Wuhan dealing with COVID in just over 10 days. The total assets under management with PFMs, private fund managers in China, last week reached 15 trillion RMB, and it's still growing. Estimates say that approximately 70 to 75% of stock and commodity market is made up of retail investors and traders. So this market is not super efficient. Year over year, the FIA puts out studies on volume rankings by exchange. 3 of the top 10 global exchanges by volume are in China. Coming in at number 3, the SHFE. Coming in at number 5, the DCE. And coming in at number 8 is the ZCE. So they're already big and they're getting bigger. Remember when trending markets existed in the US? Directional volatility was a thing when investors were intrigued by the diversification and non-correlation benefit of managed futures. It's like traveling in a time machine comparing China to the United States in the 80s and 90s. Specifically speaking, let's dive into futures. There are approximately 35 tradable commodity markets in China and 6 financial markets, 3 fixed income markets and 3 financial indices. No, I'm not talking about the 5 international markets, crude oil, iron ore, PTA, rubber, and most recently fuel oil. There's markets in China that trade nowhere else. No other exchange on the globe trades eggs, flat glass, methanol, ferrosilicon, manganese, just to name a few. What are these markets? They're deep markets. RCM has consulted and worked with sophisticated CTAs that were looking to provide market signals. And when doing their analysis to determine the capacity, they were modeling and they would only trade markets in China that they thought they could have size in, positions of north of 4,000 contracts. And of those markets, after that analysis, they thought, and they were confident they could trade over 30 different markets in China. So the markets are deep and they're growing. There are capital constraints. There are challenges moving money in and out of China. So you may have heard of east to west to east. What is that? Traders, this message is for you. What if a party could help you access mainland China money and you could provide market signals to Chinese markets? Would you be interested in learning more? Investors, are you looking to get China exposure? We see groups set up in Hong Kong that trade equities right now through Hong Kong Connect. RCM's met with a number of these groups. We've done on-site visits in Hong Kong and China and Singapore. We've had them to Chicago. We've performed due diligence and regularly communicate with them. In fact, RCM co-hosted a virtual conference with $1 billion group out of Hong Kong a few months back. Stay tuned, there's more to come there. We see both equities and futures opening up to Western investors, being able to access futures directly. We think that could happen. Allocating to PFMs potentially as early as 2021. RCM can help. Are you interested in learning more? A lot of you may be asking, what is RCM's role? RCM set up a consulting and technology WOFE in 2018 with shadow compliance, shadow legal, and accounting. RCM operates a 24-hour professional trading desk, and we've written to 3 APIs in China to help facilitate that execution. RCM assists with capital raising and distribution in mainland China. RCM has bilingual employees in the United States and China to assist with contracts, marketing decks, and communication. And we help with deal negotiations on both sides in the United States and China. What RCM is looking for is trusted partners with a global vision, both on the US side and the China side. So you may ask, what has RCM accomplished in the last 3 years since you established this WOFE in 2018? We have vetted and met with over 75 potential traders looking for China access, helping bring 9 strategies to market that have provided market signals through RCM's infrastructure, and we feel this is just the beginning. I personally have met with hundreds of potential distribution partners across China in Guangzhou, Shenzhen, Beijing, Shanghai, just a few of the cities that we've traveled to over the last couple years. I have spent nearly 2 months in China over the last 3 years. We have facilitated just under 300 million RMB in deal terms. RCM has provided market signals for over 200,000 trades into mainland China within that time frame. Deal negotiations right now for an additional 100 million RMB is currently underway through various AMAC PFMs and MOMs around China. So how can RCM help? Reach out for specifics, whether you are an investor or a trader. We see the expansion into other business lines. RCM is not a one-trick pony. Will east to west and west to east continue? We believe so. We are exploring ARB trades, but trading United States against China. We are exploring swaps and other vehicles for access for Western investors to trade mainland China futures, currently attempting to negotiate reasonable costs. We are exploring a commodity index in China, both trackable and tradable. Reach out by phone, email, LinkedIn, or WeChat, assuming the United States doesn't ban it. China is one of the best opportunities I feel I've seen in my near 2-decade career. Don't hesitate to reach out. Thank you.
And last but not least, we promised some success stories for managers who have already made the leap into Chinese trading waters. We recently co-hosted a virtual conference focused on the opportunities in China and featured some of the best strategies that we know and work with inside of the Chinese market. There's a lot of super interesting stuff in all those interviews, so we mashed up the best parts into a 4 China, Asia-based managers, 1 podcast for your listening pleasure. Up next are the best pieces with Stephen Zhao, partner at Shanghai Mingxi, Michelle Wang, CEO of Xingtai, Stephen Klein and Fred Schutzman of Jinzi Sheng 2, and Brent Belote, head of Jinzi Sheng 21. And if one of these excerpts really catches your attention, click on the manager card below to get access to the manager's full interview, pitch deck, and tear sheet. You can also reach out to us directly at mbradbard@rcmam.com for even more information. Enjoy!
Today we're joined by Stephen Zhao of Shanghai Mingxi Investment Management, a quantitative hedge fund based out of China. And the Mingxi team focuses specifically on Chinese A shares and the benefit that that brings to their strategy. And Stephen and his team have joined us for some of our events here in Chicago in the past. And our team at RCM has joined them in China a few times. So great to see you again, Stephen.
Yeah, great to see you as well.
Tell us a little bit about your personal background. How did you end up ending up at Mingxi?
Okay. Mingxi was founded by 2 academics, basically Professor Robert Steinberg and Professor Yuan, and they both from Wharton, and they both teaching there, and Professor Yuan was a PhD from Wharton as well. And actually, I have a common friend, a college friend with Professor Yuan. We were knowing each other during that time, and after graduation, I was doing commodities, and for like more than 10 years. And in 2009, Professor Yuan, when he decided not to teach anymore in the US, and he had a talk with Professor Robert Steinberg. They decided to come to China, and they started the quant shop. And he sort of talked to me, and I said, fine, I have no idea at that time, but I generally think it should not be a bad idea. So that's how we started. And I started with Mingxi in 2010, but softly. I probably spent maybe 50% of the time. And then I fully joined Mingxi in 2015. I spent 100% time. And I'm basically now in charge of all the operations and the finance, as well as part of the marketing.
So let's dig into the strategy a little bit. So you mentioned a few pieces in the beginning, but just give us the overall 30,000 foot, we call it an elevator pitch here in the US, but give us the quick elevator pitch on the main strategy. Okay.
As I said, we are now offering actually 4 different strategies, and 3 I already mentioned, which is like a intraday strategy. Basically, we're predicting 3 minutes up to 4 hours return of the stock. And so far, we are carrying a sharp around 3. And also we are doing a 3 to 5 day strategy. By the name, you can see our turnover rate is around 20 to 30% a day. And that carries a similar sharp. And also we're doing 20-day strategy. And that's of a lower sharps, but it's still 1.8. And it's been running for like last 5 years. Now we're having
like long short strategies,
short. It's like this. It's not really a long short. In China, the shorting inventory is just not available. And so basically what we do is we have a 3 strategy, but the application of these 3 strategies always have 2. One is we call the market neutral. Like you said, we do it long and short. But in shorting, because of the lack of shorting inventory, so what we do is we shorting the index future, or sometimes we just using the index swap, and rather than shorting single names. So in China, there's no long-term per se, long-short per se, but only long versus shorting index futures. And this is what we do for onshore. And another application is the same strategy. It's like we call it index enhancement. It's 100% purely long. Basically, the target is to outperform the index. Basically, we want to generate alpha. And as always, we're doing for long side only because we just can't short in single names in China. It's practically not practical in China. And these are the 2 applications. But in offshore, we're also doing a combination of intraday and 3 to 5 days because we're doing the strategy we call optima. So basically, it's optimized a signal of 3 to 5 days and the intradays. So basically, we're offering 2. Offering 4 strategies.
And so to put it in U.S. terms, the classic long-short equity market neutral hedge fund might go long Microsoft and short IBM and capture.
No, that's not what we do. Yeah.
But you would go long Microsoft and short the S&P.
Yeah, exactly. But that was not the case for our offshore partners because we have doing our SMA since last year and we launched our fund this March. But for that, the master fund, we do around 30 to 40% on shorting long short. Basically, because for the international PBs, they do have a fairly okay shorting inventory availabilities. So available. So for us, we are able to have around 30 to 40% on shorting single names. So that you can say it's like a 40% long short, and another 40% is like a long and versus index futures.
Got it. And then the names you're picking long or short is all driven by AI?
Yeah. Yes. And for our high sharp strategy, basically we are using machine learning and deep learning algorithms to combine those factors together. It's like basically if I want to say what kind of people I like, I need to give some factors. Like I want like a tall, or I want to be the eyes is big, or blah blah blah. I need to give factors. But if I'm giving only 10 factors, we used to do linear combinations, giving like a 10% weight or 20% weight on certain factors. Then we have a score. Then we see which one got a high score, and that will be the one. But now, since the 2016, we are adopting this like a machine learning and a deep learning algorithms. It enables us to combine a much larger number of factors. Actually, makes it more accurate. Actually, now if I'm describing a people, I can say, okay, I like the hair to be how long, and I wanted the angle of the chain, and I can give the 10,000 factors for that, which the old linear.
How many factors are going into the model?
It depends. Basically, I will say on average, one of the signal would maybe carry around 500 up to 3,000. Sometimes even go higher, even 5,000. Then we combine those signals together, and also, of course, by using nonlinear AI combinations, and the AI will just combine them in a nonlinear way, at which we don't understand. So far, it's black box, but the output is quite robust.
And so it's black box. So it's just assigning a score, or it's saying these are the top 10 stocks you want to be in, and these are the bottom 10 stocks.
Once we let's talk a little bit about our strategy development. Basically, we have 6 teams researching those so-called factors. Basically, like the unique features of the share market, right? And each team may this team may be more focused on finance, so there will be more intuitions. They will handwritten those factors. That team may be more into AI. They basically using machine learning itself to create factors. Then we have a bank, and then we have a group called we have AI teams. They will just combine for those each and every teams, combine for them of those their factors into one signal. Once those signal we can call this as those single signal is itself is tradable. So just say we have 6 different signals from 6 teams. Then our IC then will decide how to combine them, and they will combine them in a linear way and giving the weight actually. And then we make a mass signals. Mass signal will basically give a score by the ranking of the returns of the shares. Like say the Y. If we want the Y to be say I want to outperform S&P for China access, and then the machine will basically pick the possibility of the best return of the stocks compared to S&P for China access. And the number 1 is Multi, for example. Number 2 is Ping An, and up to like down to like a number 2,000, number 3,000. Then it comes to our like a optimizer on this like risk, because we want to control the volatilities. So after optimizations, then we'll have a basket of the shares. So the EMS the OMS will be sending those orders to the EMS, and the EMS will execute.
And so can you give a couple simplistic examples of some of the factors?
Let's say order flows. Let's say some of the factors people might understand better is like order flows. If you see the active buying is towards one directions, and then you will see if the price also is moving up in the last 3 days, then you will see you are trying to make a 3 days like a price and volume factors. If the buying order is increasing on daily and the price is all moving up, you might end up saying, okay, the 4th day you're more likely to getting a positive day for the 4th day, and this you can call a feature. Basically, this is like by some of the intuitions written by human. Also, there's some of the features which you can't understand because it's interrelated. A lot of if in there. The computer will say if the daily volatility of certain share is so much, and the volume is decreasing and the pace of like 10% every day, and if the price is going up, then what? And it's more complicated. And the computer will give a score. Say, okay, factor A probably I will give it like a square. Factor A will be squared, and factor B may be multiplied by factor C, and it will become really complicated. So it's really hard to explain.
But a lot of people would assume factors means like market cap and right a bunch of these balance sheet factors or things like that. So
we don't use that sort of data that much. That we call fundamental or accounting variables. We're using less than 10% in our model. We're using 70% on price and volume, because in the high turnover rate strategy, those fundamental data it doesn't work that much. But yes, right. Of course, in the low turnover strategy with 20 days, we're using almost 30% of the accounting variable.
And so you mentioned that the alpha perhaps only being around for a few years. Let's talk a little bit more about that. Is that as the China A-shares market evolves and becomes more, as more professionals get in there, you think it'll be kind of these ARB opportunities will fade away?
Exactly. Definitely, I will say, because look at this. If we're talking about outperforming if we're talking about like the 50 or 80% alpha, like last forever, nobody will believe that. Basically, that's just crazy. And of course, it depends on a few things. Now, so far we're able to maintain like 3+ shot, and we're talking about with 8% volatilities. We're talking about we can realize maybe a outperformance of like up to 30-50%, because we need to outperform the cost of the hedging tools, and which the shop might get polluted. And but I mean, in the long run, definitely it's towards the decay for sure. But because of the structure in China is so unique, like 2 years ago, the participation rate of retail sector is around 86%, but last year was 85%. And this year we don't have the data yet, but I assume, according to our understanding from the exchange as well as from the PBs, onshore PBs, it'll be more or less the same. So the retail asset doesn't decrease. So that's basically we guess, we can only guess that's the soil and of our alpha, and it will just remain for some time, of course. And I don't think it will last forever. As I said, I don't believe it will last forever. But yeah, I think it will take some time. It will take some time. Plus, the other way is our R&D is keep going on, and we are actually trying to catch up to so-called the international. Like, okay, give an example, like a Citadel, Two Sigma, we're trying to catch up from all the angles, and we do talk to a lot of people, and we do a lot of recruiting as well, and we have people working for us from all the those big firms, and they were working with other big firms. Now there are a lot of people joining us, and we're trying to develop to develop more strategies, as well as we're trying to improve into models, algorithms, like a trading impact, and our internal system as well. So there's a lot of room to improve as well. I think that will fight against the decay. So I believe one day the alpha will be stabilized at we call it reasonable levels, not really giving people a yield of like 15, 20, or 30% a year. That's just sounds unreal.
Right.
But that was what's happening the last couple of years.
And so the trigger for your guys' assessment of the opportunity lowering will be that retail participation rate? Like if that falls to
I will personally assume that, yes. I will personally assume that. And if the more institutionalized, for example, if the participation rate of the quant maybe it's less than around 10%, of course last year some particular time may be higher, but on average it's like 10%. If in Chinese market, if we are talking about 60 or 70% trading is from quant, then I think the offer opportunity will be definitely much less.
Let's wrap up. We like to ask all the guests a couple of favorites. So do you have a favorite investing book?
I want to be very frank with you. I don't read investment books.
How about a non-investment book?
Okay, I have if we talk about novels, I like one called Siege. The Siege. It's basically by a Chinese famous writers. It's just talking about a people siege a city, how much people from outside want to get in, and how much the people was inside want to get out. I think that's interesting and confident about human nature. It's always company, and yeah, I can call that my favorite book.
You have watched the Star Wars movies ever?
Yeah, I do. I think I watched every one of them.
Nice. So favorite Star Wars character?
I don't remember exactly. I think those people or creature you call from Naboo, with those dropping air.
The Gungans.
Oh, Gungans. Okay, I forgot his name. Maybe one of the characters called Jar Jar.
Yeah, Jar Jar Binks.
Also the name of one of our PB manager. So.
All right. Well, thanks so much, Stephen. This has been
fun.
Thank
you very much.
And we'll hope to see you once the pandemic unravels here, either in Chicago or in Shanghai.
Sure, can't wait.
All right. Thank you.
Thank you.
Welcome back to the Derivative Podcast, listeners. I'm your host, Jeff Malik, and have a trio of guests with me here today to talk about China. And not just the coronavirus or trade wars, but trading derivatives in China. This is the derivative, after all. We're talking futures on things like rubber, rebar, and apples, which have quietly sneaked into the billion contracts a year club with the likes of the CME, Eurex, and the like. I'm joined today by Matt Bradbart of Jinshi Shang. Did I say that right, Matt?
You certainly did.
Jinshi Shang is RCM's China subsidiary. And we also have Stephen Klein and Fred Schutzman of Abington Global, who are running their quant models on Chinese markets. Welcome, everyone.
Ni hao.
Thank you.
All right. Do we want to do the rest of the pod in Mandarin?
It's going to be a short podcast.
All right. That's as deep as we go with the... what did you say? Hello?
Hello. That's correct.
And, I think it's very apropos to have Stephen and Fred on as guests because they're one of the managers that have had a lot of success.
And so the general idea was, instead of everyone was trying to get money out of China to trade on strategies, you said, hey, let's get strategies into China in order to have their money trade those strategies.
That's exactly right, Jeff.
And talk a little bit about that. Why can't anyone just run their models on the Chinese markets? Is there regulatory issues?
Yeah, so there's a lot of nuances that exist in China that you wouldn't even think of. In other words, you have to, unlike the United States, you have to tag orders if you're entering or exiting the market. In theory, in the United States, if you're long, call it 500 corn futures contracts, and you want to get short, call it 500 corn contracts, you could sell 1,000 and reverse in the market. In China, you have to do that in two separate orders. So you'd actually have to sell 500 to go flat and sell another 500 to reverse. So there's little nuances like that. There's capital controls where you cannot get money in, money out. And there's certain regulations that only AMAC licensed entities in China can represent funds. So, it's been a wild ride and a lot of work and a lot of diligence over the last couple years, but we're starting to show success in that. We've brought 6 strategies to market, and we think we'll be able to double in size, expand our distribution, and grow our AUM in 2020
And back up a second. So if Fred, back when he's running the 247 million, said, hey, I want to go trade these Apple futures in China, I'm going to just open an account and start trading those futures, he can't do that?
That's true. So what we've done through partnerships in the United States and China is we have Chinese market data, which we're able to provide just for backtest purposes to systematic managers so they can run a backtest. We have certain mandates from our distribution partners in terms of what they want it to look and feel like. Once they give us a backtest, just hypothetical backtest on their models, which to Fred's point, he's applying the same algorithms that had success in the past in the United States to China. And through a consulting agreement, we are able to take those market signals from, in this instance, Fred or other systematic managers, and partner through a consulting agreement in China and provide those market signals to those PFMs in mainland China.
Got it. I guess what I'm getting at is as of now, only Chinese money can trade Chinese futures markets.
Yes, because the capital controls money, it's very challenging to get money out of China into the U.S. and very challenging to get non-Chinese money into the country.
So the whole concept here is provide strategies to Chinese money trading onshore Chinese markets. So guys, Matt comes to you with this idea. Stephen and Fred, you said, hey, Fred, you were starting to talk, or was it Stephen, of, hey, let's run this, let's backtest it, see what it looks like? How did that go down? What did the initial test look like?
The test was great. The numbers were fantastic. We had 30% annualized returns. So the numbers were so good, I was actually surprised. And since we were using the same models with the same parameters that I had used in the U.S. for the past, 15, 20 years, we knew there was no optimization, no backfitting at all involved, and we knew these were legitimate backtest results.
It was the ultimate out-of-sample test?
Exactly.
Yep. A technician's dream, right?
Yes.
And so let's get into a little bit of what these markets look like. So when you guys got the data and you started looking at the markets, you didn't know rebar from soybeans, right? What have you seen in terms of volumes and market spreads and things like that?
We feel these markets they're thick markets, they're liquid. We've never had issues with volumes or fills. They're good markets to trade. China has some of the most liquid markets in the world. There was a little bit of a learning curve. We learned, for example, not to put market orders in on the open. Stephen has a lot of experience executing orders, and he's helped us improve our fills over time. Thanks to Stephen, the fills we're getting in China are as good, if not better than the fills we could get in the U.S. at the moment.
Got it. Do you have or Stephen, do you have a market that you would equate it to in the U.S.? Like it's not as deep in liquid as the E-mini or something, right? But do you have a market where it's roughly equivalent to?
I would say it's kind of similar to gold or crude oil in the U.S. But we've had no issues on liquidity in any market yet in China. And I would just say that it's really similar to what it was like trading futures in the U.S. in that 2000 to 2004 window.
In terms of like directional volatility and whatnot?
The small details of execution, how it feels to execute in the moment, slippage, and slippage not being bad, sometimes even being positive. The fact that if you have a trading error that often it actually works out to a profit, that's something that reminds me of 2003. I don't think I've had a trading error in the United States that's been positive in a decade plus.
Those have transferred to high frequency shop profits.
I feel that the reason why the Chinese markets are so much more beneficial for us to trade is because you have an exchange technology level similar to what you had in the U.S. in the 2000s. That exchange level technology being at that same level makes it harder for high frequency trading shops to execute their trades. I also think that the regulations in China are, in my opinion, better enforced than they are here with what we just recently saw with Citadel. China is actively trying to protect their markets and the order of them much more so than what I see in the United States.
And so the exchanges and the regulators haven't kind of opened the door to the high frequency pirates or wonderful people, whatever you want to call them. But
they're clearly glad to have them. And they seem glad to have most market participants that are using Chinese onshore currency. But if they step out of line, they have no trouble literally shutting them down for years. Citadel Securities were shut down for a number of years in China and only recently was able to pay a very large fine to begin trading again because they were caught spoofing one order. In the U.S., that's the normal course of business. And so I think eliminating that type of predatory market action and also having exchange technology that doesn't have native orders for, spoofing orders as a native order type, as we find in the U.S., where many exchanges actually have that as an order type. Though, of course, they don't refer to it as spoofing. Right. But that is exactly what the order types are that are offered by U.S. exchanges to some of these customers. China does not offer that. Now, a downside is that when you go to do a spread, they also don't yet have spread functionality built in, so I do have to leg each order in.
Got it. But it kind of goes back to your skill level too, right?
Yeah, and you're not, I think what you've done better than some of the other traders there is you're not giving up edge on both sides either, where you may do a market order on one leg and then work a limit on the other. So working the order has been to your benefit versus just a spread order like you do domestically.
Yeah, Matt, I absolutely agree with that. And I think one of the things that, Fred so kindly said that, I was one of his best brokers back in the 2000s is that if you just operate with a little bit of care, you really, really see the benefits in China today. And back in the early 2000s, you absolutely saw the benefits. Like my ability to run, without even putting in a great deal of effort, my ability to run laps around people in regards to slippage and spreads was almost effortless. I just needed to pay attention and to care for each order.
Fred, I'd like to throw it back to you and talk a little bit more about the strategy of exactly how you modeled it, how it's working on these markets. You don't have to give away all the secret sauce, but give us some guidelines on what the strategy is doing over there.
Sure. The models that we built are basically constructed to capture trends. any market that trends, should be profitable when you apply these markets. And, we didn't just look at the last few years of data or just China or just the U.S. I've tried to incorporate as much data as possible. And when building systems, we looked for at least 2,000 trades. That's our sample size. Anything less is not that statistically significant, in my opinion. So we built models based on a lot of data that should work in, any market around the world as long as it's trending, and any period of time over the last 40 years or more.
And so unpack that a little bit of as long as it's trending, right? There's people who would say that means it's got to be 2 years in the same direction. There's some people who'd say it's 2 hours. What do you mean by it has to be trending?
Say 2 weeks to 2 months would constitute a trend, in my opinion.
And it's classic kind of volatility breakout entries on the trend?
We have various systems, some are volatility breakouts, some are trend breakouts, some are longer term, some are medium term. We've tried to diversify as much as possible among strategies, among time frames, among concepts.
And so how many different strategies and time frames are implemented on the China portfolio?
On the China portfolio, we're trading 3 different strategies and 2 different time frames.
So the 3 different strategies, it's 3 separate unique entry points and exit points?
Exactly.
Got it. And the time frames, again, across those 3. So you have 6 different entry exits?
Time frame, 2 of them are medium term systems and 1 is a longer term system.
And then if you have, will each of those give a signal in the same market, or if it's one market gets a signal, that's it, and then you wait for another signal?
Each one is run independently, so the best signals over time have been when all 3 systems have kicked in and we've received confirmation.
Got it. So it's kind of a built-in voting machine of,
exactly. If it's a weaker trend, maybe we're only getting 1 or 2 systems generating buy signals, for example. So if it's a 1 system buy signal, it's usually not the same high quality trend as, say, a 3 system buy signal.
And so how is that different from when these models were working in the U.S.? It's just more trendy?
No, it's identical. The only difference is the Chinese markets are trending a little bit more. The models that we built work in the U.S., but they don't work as well currently since the U.S. markets aren't trending as well.
Right, so volatility, and you have more directional volatility over there than seeing in the U.S. commodity markets.
Exactly. And we built the models to really do what we would do subjectively if we were looking at charts. If a market is breaking out, like gold, for example, if gold is breaking out to the upside and, the more confirmation you have, the better the signal. Right now, gold has broken out on a daily, weekly, and monthly time frame. So, there's an uptrend in 3 different time frames, so it's a stronger signal. I can make a good case gold is a solid uptrend here in the U.S., and the way the systems were constructed was, they're doing exactly what they were constructed to do. They're capturing what we see on a gold chart.
Is there any protection against volatility decreasing across every market in the portfolio? Or is the main protection and kind of coverage against bleed and low volatility times the diversification across all these different markets?
It's more the diversification and the different concepts that we're employing. There's three different systems. One is more of a trend or a volatility type of breakout system. Another one is a pattern recognition system. So we're looking at price patterns, say Head and Shoulders bottom or a double top. And the third one is a long-term statistical system.
Yeah.
So the protection is basically that if a market is not doing what it should be doing, we're not going to be involved in all three systems most likely. If a market is going up slowly with a lack of momentum, then we're not going to be long all three systems. It's a lower quality signal. Not only that, each system has built-in exits that dynamically adjust. So if we're in a period where markets aren't doing what we think they should be doing, hopefully the model will identify that and tighten stops.
And for this session, we have Michelle Lung, founder and CEO of Xingtai Capital Management. Michelle's extensive background includes Ivy League schooling, regular contributions to Bloomberg and CNBC, and stints at big investment firms around the globe. So thanks so much, Michelle, for joining us today.
I'm born and raised Hong Kong.
Okay, great.
And I finished high school here and did my first year of university in China, in Peking University, Beida. I then completed my bachelor's at the London School of Economics. And my first work experience was actually at the United Nations for 3 years, so I did something completely different. And after 3 years at the United Nations, I went to Harvard Business School and completed my MBA, class of 96 from HBS. And after that, I joined Goldman Sachs, and I was in Goldman Sachs in investment banking for a number of years before I started my operating in private equity and investing career. So I started life as a COO of a listed Chinese consumer business. It's the company is under the Hutchison Whampoa Group, and it was listed in the year of 2000. I was there for 5 years in an operating role. And after that, I was part of a team that started a private equity firm, Luna Capital. And Luna Capital invests in privately owned Chinese consumer businesses. And it was whilst my time at Luna Capital that the idea of starting Xingtai Capital came about. I started Xingtai Capital over 5 years ago. And we've now have a 5-year track record. And we run a long-only strategy investing in Chinese growth equities. I'm the founder, and I have a partner who's a CIO, and his name is Bing Chao Zhao, and he's from China, from Zhejiang province. So the whole thesis of what we do is Xingtai Capital, we're a value-driven investor in growth. So what we try to do is capture the highest growth in the stocks that we pick, whilst paying a lot of attention to valuations we pay for that growth and being very focused on the margin of safety. We like to do most of the research ourselves. So we really take more of a private equity-like approach to investing in public equities. We do our own channel checks. We put a lot of focus on frequent and in-depth management dialogue. And so we use what we learn from management and what we see on the ground through channel checks to build our financial models that yields our investment thesis. So the fact that we're on the ground in Shanghai is a really critical part to what we do.
And then help me understand, coming from the U.S., it seems that all of China is a growth stock compared with U.S. growth and value. So how do you delineate what are the boundaries for growth versus value in Chinese equities?
Right. So if you look at the MSCI China, we have very little overlap with the MSCI China. I think our top 10 positions represents like 0.6% of the MSCI China. So the MSCI China has all kinds of exposure. It has exposure into consumer and growth stocks, which include technology, healthcare, e-commerce, etc. But it also has exposure into financials, commodities, energy companies, etc. We are only looking at the growth and consumer end of the MSCI China. So if you will, we take a very broad interpretation of what we think is consumer driven and what we consider growth, but we would not invest in a state-owned enterprise industrial or a large bank or a commodities company. So we try and stay away from the state-owned enterprises. We try and stay away from the large industrials and financials and commodity companies. Everything else is really in our universe.
And so what are some of the names that would be included in that universe that people would know?
So included in that universe would be definitely the names that you would know well, which is Alibaba and Tencent. We in general are not invested in a lot of the consensus names, but those names would be in our universe. So what the way we look at growth is we try to capture growth where we think that in a China context for us, growth means everything that is somehow related to the consumer. We think that the economy is now restructuring into a consumer and domestic demand-led type of economy. And we believe that growth in the next few decades in China will be driven by Chinese consumption. So what we try to look at is what the underlying driver of growth is in a company. And if we deem it to be driven by consumption, we will consider that stock to be in our universe. It's very interesting because a lot of people don't realize that even though China is the second largest economy in the world and will be soon the largest consumer market in the world, it is a very young economy in terms of the consumer economy. I mean, it is just 30 years old. Most of the stocks we cover were listed, the early ones listed around between the year 2000 and 2005, but a lot of them were listed from 2005 to today. So a lot of stocks we cover are quite newly listed. And overall, the way the consumer economy has evolved is that China did a great job building the consumer infrastructure in the early days. So we have great infrastructure in terms of an e-commerce backbone, in terms of distribution channels to distribute products. And what we're seeing now is a lot more product coming online that are filtering through filtering through the infrastructure. Right, so that's a very classic example. So that brand actually is one of the earliest consumer companies in China. It was founded in the 70s, and that brand's gone through evolution over time. So everyone growing up in China in the 70s and 80s knew this brand Bozidang, because that was the main brand in terms of if you wanted to buy a down jacket. And that brand the stock actually lost a lot of market value in around 2010 because it had issues dealing with inventory channels being overfilled. They built too much capacity for the growth that they actually saw at that point. So they thought growth would be unfettered in around the early 2000s. So they built this huge infrastructure of distribution channels and stores, and they overbuilt and faced stuffed inventories and all kinds of issues. So the stock actually lost 90% of its market value around between 2010 and 2012, but then went through a restructuring. And after that restructuring is when we invested. So we saw that there was going to be a recovery coming online, and we invested at a very cheap multiple, around 10 times, because we thought that growth would recover to 30% plus per annum in terms of earnings growth. So that's a very good case study for us in terms of how we capture recovery growth. But Bozidang is a big consumer brand in China, and it was a very staple type of consumer brand in terms of just a regular down jacket, and it's actually evolved into quite a premium consumption type of positioning. So they now have multiple types of price points. They're quite fashion conscious. It's a very different company than it was over the last 20 years.
Yeah, the model, and you're showing off her sleeveless down jacket in your deck doesn't look very, that looks pretty fashionable.
No. So what people associate with the old Bozidang was just a regular plain down jacket, and now they do ski wear, they do fashion items, and they have many different price points.
So how deep will you dive into that company? So you're betting on the recovery just of that company, or was it in the broader upmarket as well?
In that case, it was just in the company. So the way we like to capture growth is we like to capture two types of growth. We like secular growth, which is blue sky scenario, newly listed company or sector where they're just seeing 5-10 years of limited competition and very strong growth. We also like to focus on, so Alibaba, when it was first listed, is an example of secular growth, right? Yeah. We also like to focus on recovery growth because a lot of consumer companies in China have gone through cycles we've seen over the last 10 years where they were once a high flyer, but then like Bozidang lost 90% of their market value, trading at very cheap multiples. And we like to capture value dislocation. So we really like companies like Bozidang where we can invest at 10 times and we can see very strong recovery coming back online before the market. So another thing we like to do is we like to invest quite early. If you look at sort of our top positions and positions that have generated the most alpha for us over the last 5 years, in general, it's in stocks where we were very early. And what we mean by early is when we invested, there was limited or no sell-side research coverage, and where we're one of the few or earlier institutional investors. So in Bozidang, obviously, Bozidang it was a large cap company, lost 90% of the market value. When we invested at 10 times, when it was a small cap company, no one was talking about Bozidang because everyone had written Bozidang off because it lost so much market value. What we did in the case of Bozidang is we went in, we had in-depth discussions with management, and we did our own channel checks. We talked to their distribution channels, and our hypothesis was that we saw same-store sales recovery in multiple provinces, and we projected that they would have a very strong recovery. The market didn't agree with us. In the case of Bozidang, we invested in 2016 at 10 times, and the stock was flatline for 24 months. So, it didn't lose value, but we invested 10 times, it was a flat line.
Yeah.
After 18 months to a 2-year period, the market then recognized that growth was very strong and had gone through this huge recovery. And the stocks after that went through, a 200% growth between 2018 and today.
Great. And
so that's it. Yeah.
So what does it look like now for your exit? So how do you monetize that? Is there, do you have formulas for that, or it's just again, checks and feels for when it might turn over?
Right. So with fundamentals, bottoms up investor, we rank everything in terms of risk reward. So we usually take profit when the risk reward no longer makes sense for us, or it's past our projections where we think it's fully valued and we think that it doesn't make sense anymore. Or if we see other stocks in the portfolio or pipeline that represent better risk reward, we will then trim the existing position to replace it with other stocks that represent better value for us. So in the case of Bozidang, our thesis is that the stock is still attractively valued. It's at 15 times earnings today. We still see very strong growth over the next 2 years. So we're still holding a high conviction position in Bozidang. But we have other examples where, we invested, the stock saw very strong growth. We invested in another stock. It's a hot pot food condiment stock. It's called Yihai. That stock was one of our best performing stocks in our portfolio over the past 5 years. We made like 12x on that stock. We invested at 11 times earnings in 2017, and we sold the stock in 2019, 2 years later, because at that point the stock was valued at 35 times earnings, and we felt the risk reward no longer made sense, and we had other positions in the book and other ideas in the pipeline that were more attractive.
And that's just like a ramen noodle kind of thing, off the shelf.
It's actually hot pot is a cuisine that is very popular in China. It's 25% of the dining industry in China. So it's a huge hot, and it's basically a.
But this was do it from home. Take it home.
This is the key condiment. It's like the ketchup to hamburgers.
Oh, got it.
Is what this guy is. So this is like the key component, the key condiment that you need to eat the hot pot cuisine, because a hot pot is just a boiling pot of water where you boil food. So the whole condiment, the sauce, is the main ingredient. So this is the
I love these
yeah.
kind of stories, right? Like you read papers and read news articles about someone caught 10 cent and this and that, when there's real money to be made in the boring stuff like hot pot condiments, right? That's good.
Right.
And so it seems to me you're saying like you're trying to capture these growth stocks, but at value prices a lot of the time.
Correct. We're a value investing growth, which a lot of people say, well, everyone wants to be that. Everyone wants to do that.
Right.
But the fact
you might
is
wait
that
30 years to get the right opportunity or whatnot, but.
Yeah. So, we look for value dislocations. Those dislocations will either come in stocks like Bozidang that have gone through correction and are about to recover, or they will come in opportunities where the market is either overlooked, ignored, or misunderstood a stock. So, for example, in the case of Yihai, the market overlooked and misunderstood this stock because it was IPO'd shortly before we bought the stock. The IPO was not successful, and the stock corrected right after IPO, and that's when we invested. But
And
the market was.
Sorry, go ahead. I was just going to say, how much pain will you take on if you got in early and it's still going down? Will you take
That's
it?
a very good question. Yeah, that's a very good question. That's the tricky part about the recovery growth stocks that we invest in. So timing is really critical. We will usually wait for anywhere from 3 to 5 quarters of recovery before we invest. So we won't invest after 1 quarter of recovery. But oftentimes we're early. So in the case of Bozidang, we were early. The stock didn't do anything for 18 to 24 months after we invested. And in some cases, like you say, we invest and we're facing this falling knife situation where the stock keeps correcting. We've had those situations early on in our 5-year track record. We had a few of those cases in the first 2 years of our track record. And in some cases, if we hit a stop loss, and we felt that we had no information edge in understanding why the stock kept correcting, we would we would consider trimming the stock in half or taking some risk off the table. So we actively manage a portfolio. We're a long only manager, fundamental, long-term driven. We like to hold stock for 3+ years. All our models are done on a 3-year basis. The turnover, the portfolio, in terms of name turnover is low. It's around 30%. Volume turnover is higher. It's 50% plus because we actively manage the exposure we're in. So China, like you said, is a great growth story. And, but at the same time, it's a very volatile market. So the growth dynamics and the competitive dynamics within each sector, within each company can change very rapidly. So you can't afford to not be very focused on constant information updates. So the portfolio's positions in our book, we talk to the companies every month.
And then I'm reading all this news on like Luckin Coffee. Is that how I say it? So
yes.
how do you avoid those landmines, so to speak? How do you avoid those traps?
Right. So a couple of things. So obviously corporate governance is a big issue, and we're very focused on it. We tend to only invest in companies where we have some assessment of management track record. So we either know management, or we know how management has guided and performed in the past, or we have reference checked them versus other peer companies or other people we know in our network. So we would rarely invest in a company where we don't feel comfortable with management credibility and management track record. So that's the first thing. The second thing is that we never invest in companies that don't have positive earnings and don't have some kind of history of earnings. So that's the second point. We don't invest in companies that are newly listed and overnight have this huge market cap but don't actually deliver earnings. That's not in our focus area. We like to understand the driver of earnings and sales and be able to verify it. So in a case like the company you mentioned, because of the rapid growth, because of the network of reps that they're relying on to drive sales, it would be very difficult to diligence, where the growth is and how that growth actually happened. So that would be something we would stay away from.
good to hear. I think U.S. investors read that, right, in the papers, and they say, like, this is why I don't want to invest over there. You can't tell these things apart. You're going to run into these. But you're
Well,
saying,
I don't
like,
think that's the case. I don't think that's the
yeah,
case, because if you look at, what we look at in companies is clearly we look for high growth. Clearly we look for, comparative market positioning, but we also focus on a couple other things. We like companies that are in net cash with limited leverage on their books. We like companies with a historical track record of earnings. We like companies where we have active and accessible management, where management is willing to talk to us every month. So if a company doesn't fit into that type of profile, we will likely pass on investing in the company.
Yeah, and I think some investors would say, well, how do I trust those numbers? So I guess, how do you guys trust the numbers? Because you're doing channel checks and you're seeing the brand and feeling it.
Correct. So if we're looking at an infant milk formula company, we will go to channels, we'll go to the stores, we'll go to hypermarkets, we'll go online, and we'll see what the shelf space is like. Does the sales and the branding look like they're generating the sales they are? And we'll talk to peer companies. We'll reference check with peer companies to see what the competitive positioning of the company actually is.
One more question on the RIT. So in your deck, you kind of talk about strong downside protection, which you just mentioned, but you also just mentioned, but there's no hedge, there's no overlay. That's just based purely on the skill in picking the companies.
Correct. So all the alpha we generated is just from stock picking. It's a straightforward long only strategy.
But the downside protection is based on also not chasing high performers. And
so we're not in high beta names. We're not in highly valued names. So, we're not in the consensus names that would trade according to the market beta. So and we're in names that are very cheap, right? Average PEs are 13 times. Yeah. So in a down market, we often see that we are not tracking the beta, and we are capturing less than half of the downdraft.
That's great. So let's finish it up here. We finished up asking you some of your favorite things, which is our standard. So
okay,
we'll just go through these quick. Favorite investing book?
Favorite investing book, I guess Intelligent Investor, as a value investor.
Yeah, I'll take it. Favorite restaurant in Hong Kong? Where do I got to go when I come visit?
Wow. Okay, that's a tough one. I have so many. So I would say a good classic is China Club.
China Club. Okay.
Yeah.
Are you a podcast consumer as well as now a contributor? Do you have a favorite podcast?
I'm not a big podcast consumer, but I like the McKinsey podcasts.
Okay, I haven't read that one or read it. Listened to it. Sorry. How about your favorite place you've lived in all the different areas you've been?
I would say Hong Kong.
Okay, Hong Kong. Who's second place? Where were you when you're in the U.S.? In New York?
I was in New York. I love New York as well.
New York or London. All right. And then finally, I don't know if you're a Star Wars fan or have watched the movies, but favorite Star Wars character?
Not a Star Wars fan.
Not at all? How about Princess Leia? Have you heard of her?
Right, yes, Princess Leia, yeah.
All right, we'll give you Princess Leia. Well, thanks so much, Michelle. This has been fun and informative, looking forward to talking again soon. Today, we've got a young star in the energy trading space, Brent Belote, founder of Kaler Capital. Brent joined us a while back on the pod to talk through U.S. oil prices going negative for the first time ever, and excited to hear his thoughts on how he's approaching the Chinese oil futures markets. So thanks for being back on with us today, Brent.
Thanks, Jeff. It's been good.
And so give us a little background on you, how you got into energy space and where you grew up and everything.
Yeah. I grew up in the Bay Area, in Petaluma, small town. Went to school down in LA at USC and got into the energy markets. I did grad school at NYU, did my MBA in quantitative finance and econ, and then got recruited to JP Morgan, where I worked on the oil desk for 10 years. So at first I was in charge of North American oil fundamentals, running kind of supply demand balances on anything in North American crude, looking at crude grades, pretty much anything that moved oil around the North American area we tracked. and then switched over and worked on oil product derivatives, focusing on gasoline and heating oil for the last 2 years of my career at JP Morgan. And in that regard, I spent a lot of time looking at refinery economics, jet fuel hedging strategies, pretty much anything that moved now, gasoline and heating oil and demand.
Now let's talk a little bit about the main strategy that you run in the U.S. and what that looks like. What are you doing?
So Kaler Capital Systematic Energy Diversified is the primary strategy that we run here in the States. It takes all the fundamental data points that I aggregated and built up at JP Morgan, and we apply a systematic approach to fundamental data. So we look at all the supply and demand micro markets of the world. We're looking at basically 6 primary ones: WTI, Brent differential, gasoline cracks, heating oil cracks, and then a option model as well on WTI. And we look at the underlying fundamentals of those markets, looking at supply demand. So on the supply side, I'm looking at shale forecast, shale current production, and the movement of oil around the world as well. So imports, exports out of the Gulf Coast, pipeline flows around Cushing, Oklahoma, refinery economics, how much gasoline, heating oil, et cetera, is being created around the world, and shipping movements as well, a lot of primarily around the Middle East.
So you take in all these fundamental factors, create a supply-demand picture for through those data points, through that model, and then discretionarily make the decisions, or the model itself kicks out the buys and sells?
Yeah, the model kicks out buys and sells. It's an end-of-day model, so at the end of the day is when we will execute or enter or exit trades. And yes, the inputs are all fundamental data-based. It tells us where along the curve we should be. Should we be in the front of the market? Should we be farther out? And dynamically adjust for kind of increases and decreases in volatility. So obviously, we had a great March, April, but it was very volatile, even if it was positive volatility. So right now the model is investing in December futures contracts, nothing in the front of the month, to try to tamper the volatility and really stay out of the noise of the macro environment.
Let's talk China. So interested in your strategy. So now, once you learned about the opportunity in China, were you saying, cool, I'll just port this same model over, or what did that look like? And
no, so it was kind of an interesting transition. So the way the model works here in the States is it inputs all the fundamental data, and obviously getting fundamental data in China is probably a non-starter, especially with all the, I trade 13 products kind of across a macro. So my question, and when I started looking at the data, can I run the last leg of the algorithm that I run here in the States and see if it has relevance across China markets? And that data looks at spot prices and the term structure that is currently going on between there. So, when I ran the data, it really kind of popped, and I was actually surprised at how well the term model algorithm that I run as kind of the last hurdle for entering into positions worked for China. And it's been working fantastic since we launched in early March. And so we run 13 markets, kind of a gamut of financial, ag, and glass. No energy, ironically, but the metals have done fantastic. So it's interesting to see how this model has performed across different asset classes.
So you're taking the same energy market inputs, and then, or you're just saying you just took the curve model and put it on the chart?
So like I said, so I took the last portion of it, which is looking at term structure. So it looks at the spreads between different parts of the curve, and so analyzes those versus the best ones. Yeah.
Left the other fundamental factors behind.
Yep.
And so what does that look like? Have you thought of stage 2 of actually getting some of that fundamental data and running?
Yeah, I've looked at it. The biggest issue that I'm running into is timely data, number one, and then number two, trying to audit it or have an idea of what I'm actually looking at. It's tough. It's tough to dig through it. Yeah, it's tough. So I think that it is possible, but I think it would involve probably a full-time Chinese analyst or someone over there to scope the data and make sure that it's actually, to scrape it and dig in and make sure that I'm not just, to be honest, running fake numbers and trying to take positions on it.
Yeah. And so how have you found the trading? As liquid as you thought, less liquid, more liquid?
More liquid than I thought. Very surprised. I think they did something really smart with that, where the futures contracts are very small for a lot of the markets, and I think it's smart to start that way. Whether you click a button for 1,000 or you click a button for 10, it's pretty much the same thing, and it doesn't price people out. So it's been encouraging to see the number of contracts that have actually been trading. And the algorithms that are run look, and they only trade the most liquid futures contract to avoid this. So we tried to stay out of the fray and not end up with a situation where the bid ask is so wide that we're causing issues with it. So.
And so let's go through those markets again. So what are the 14? Sorry to put you on the spot. Yeah.
Yeah.
Or give me 5 of them.
Yeah. The 10-year gold, Chinese 10-year gold, silver, cotton, polypropylene, hot rolled coils, rebar, soybeans.
I just love the names of some of these, right? Did you ever think 3 years ago you'd be trading hot rolled coil and rebar?
No, or rebar for that matter. No, like I said, it was interesting to see where, my first way I ran this was I took each individual market, and I ran the, kind of my inputs for this algorithm on it. And I looked at them on an individual basis. So these 13 were the ones where it really worked. And there was some that it didn't. And I was surprised that for the energy space, it didn't. I think the reason it didn't for the energy space in China was just purely liquidity and lack of data. So I don't think it went back far enough. And I think the liquidity factor meant that, the curve, if you're looking at the term structure of the curve, if only the front 2 months really update or change, and the back of the curve is static for 4 or 5 days, is that really static, or they just not update the data? So I think it was more a function of just kind of stale data. And I think if you dug into it, and as they get more liquid, you'll find that it'll probably add markets.
These 13 kind of have the fullest curves of the markets over there.
Yeah, exactly. I tried to stay in the front 6 months, and they had to be a certain threshold of liquidity, and they had to have a certain term structure and bend to them.
And so just give some example trades. So you'll go long the June rebar and short the diesel rebar is kind of.
No spread. So it's only directional. So these markets are only directional. So we'll be long or short a given number of contracts in each of the 13 markets.
But not always in the front month. You might go into the back months?
We will only go in the most liquid contract based on open interest.
Okay. Which is typically one of the first 2?
Typically, yeah. Some of them trade in, it's kind of fascinating because some of them trade in almost quarterly increments where, gold will be like a June, September, December, and some will be 6 months rollouts to the next liquid contract. Like copper goes from June to December, I believe, pretty much every time. So it's been interesting to see how the rolls occur and where they are.
Well, thanks so much for joining us. We're going to do a couple quick fire favorites questions to close out. Favorite investing book?
That's a good one.
Or I'll give you any book.
Investing, I'll go with Jesse Livermore. I think it's about a plunge.
Reminiscent of a stock.
Reminiscent of stock. Yeah, I really enjoyed that one. It kind of made me think about how, how and when you should be buying and trying to spot that. And then Nassim Taleb wrote one is dynamic option hedging. It's a very technical book, but it's been very prescient and very nice, and I've used it in a number of different markets. It's more about option pricing and option models, but it's been fascinating.
Favorite national park near you there? Grand Teton or Yellowstone?
I like Grand Teton. It's just close. It's easy. There's great lakes there. Yellowstone's beautiful. It's a little crowded. And it's a little far. So Grand Teton for sure for me.
Got it. And then favorite Star Wars character?
That's a good one. I am a Star Wars fan. The new ones I haven't really appreciated the new ones. So I'll stick with Luke Skywalker. Just be a very vanilla win.
Yeah.
to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.